So before we even get into chapter 7, I just want to kind of set this up a little bit for you and do a little background. Where we're at now is compiling a financial statement, two of them for a service business, and that is a income statement and a balance sheet. Now, we have been looking at a sole proprietorship this whole time. All right. One person owned business, usually pretty small, not a whole lot of different accounts or anything going on. But we can still work on looking at those financial statements to tell a story. And storytelling is really important. That's like really what accountants do. You guys have been doing a lot of the base work, understanding T accounts, how that stuff works, how to make journal entries, how to post things, how to work with debits and credits and make sure that they're equal. But accounting really gets into this piece here, which is all about the storytelling that happens with it. All right. And there's two sides to every story, as you know. And so this is just, I have some cartoons that I'll show to kind of illustrate this point. Because when we talk about an accounting business, we can talk about business owners, we can talk about stakeholders, we can talk about users of the business. So if you think just in general about Delgado Web Services, a web service design business, sole proprietorship, very small, takes on probably one job at a time, doesn't have any other employees or anything. You can look at it from the business owner's perspective, the business's perspective itself, right? And whoever he provides services to, all right? And those would be the users and any stakeholders that have a part in his business. So where accounting 2 goes, this is accounting 1. We do accounting 2, look at accounting for a corporation and a merchandising business. So this is a service business, sole proprietorship. When we look at financial statements, those are huge things. Like they are very, very, very highly used and very necessary documents that people use for all sorts of different things. All right, whether you work for the business or whether you're a stakeholder in the business. And by stakeholder, I just mean the people who are impacted by that business's, services or whatever, right? So manufacturers of cars, for example, like Toyota, that company has stakeholders. They have shareholders, people who invest in their company, the owners of the business, right? Technically. But then they have all these other people on the roads. Like if you drive down the road with a Toyota, you are a stakeholder because you're impacted by the safety features and the capabilities of that car, right? If a car manufacturer makes a car that's unsafe, it impacts other people out on the road. So it can be as closely, defined as people who are owners of the business, but it can be as broadly expanded as people who just have anything to do with the business at all. So these cartoons, real quick, if we look at this, there's a person standing on a desert island, sees a boat and yells boat. But if we look at it from another perspective, we have the person in the boat seeing it a little bit differently, right? Ultimately, they're two different people seeing something from a different point of view, but they're both seeing the same exact thing, right? These optical illusions, where somebody on the left sees 4 logs and the person on the right sees 3, right? Because it's an optical illusion, like an MC Escher kind of thing. And then this one is kind of my favorite. Stakeholders, like parents, you guys remember mobiles? Did you guys ever have a mobile when you were a kid? Something, or make those in class where you like have coat hangers and you hang stuff from it and they spin around in a circle and they're meant to entertain babies or kids or whatever. So parents think that that's cool, right? There's a mobile of a bunch of little stuffed animals going above the little baby. But the actual user experience is they're just staring up at animal butts, pretty much, right? So it's a different perspective, but who knows how much babies really love to stare at animal butts, right? Maybe they like that a lot. Maybe they don't. Who knows, right? It's entertainment. There's something moving around, but it's a whole different perspective from the user perspective or the stakeholder perspective. So we look at financial statement analysis, and we are only going to look at 2. We're going to look at the income statement and the balance sheet. And we should be pretty familiar with this stuff by now. Assets, liabilities, and owner's equity are items on the balance sheet. Revenue and expenses are on the income statement. And we do this so that we can judge the health of a business. That's the whole point of this stuff, okay? Investors do this stuff all the time. You can go on right now for like Apple, right? Apple makes phones. They make cloud computing stuff. They make desktop computers. They make Apple, TV Plus. They have all sorts of different products that they sell. And you could go on there and you could get a balance sheet and an income statement for Apple. And if you are an investor looking to buy a share of Apple company, right, because you want to own a piece of that company, you think that they're going to keep being around, they're going to keep doing a good job. How do you make any sort of a decision about whether they're good or not? You sure probably hear a lot of stuff in the news, and you probably have a thing that's like, well, everybody has Apple stuff, so why wouldn't I invest in them? But there's a lot more to it than that. All right. And if you're an investor looking to invest in a company, you need to look at their financial statements. That's really ultimately what you should do. And so we use that stuff to judge the health of a business. So just a question for you guys real quick. What would a healthy business look like using these words? What kind of qualities would a healthy business have? What do you think? Based on what you've learned so far, throw out some ideas. What do you got?
Net income.
Net income should be, well, it should be net income, right? What does that mean, though?
They're making money.
They're making money. Exactly. Absolutely. Net income. Their sales should be higher than their expenses, right? They shouldn't have a net loss. That would mean that they're spending more than they're bringing in. That's kind of a bad sign, right? Good. That takes care of our income statement. What about balance sheet? What sorts of things would you want to look for in that? It's a positive or negative relationship. Again, I'll give you that hint. Come on, you guys. Why don't you put your screens down for 1 second? Just tilt them real quick. What about the balance sheet? What should be happening up there for a healthy quote unquote company? They should always equal, absolutely. But we said, do assets always equal liabilities? No, right? Because if you add in owner's equity, that makes up the balance. So yeah, those three things need to, well, assets need to equal liabilities plus owner's equity. What about if a company has a lot of liabilities? What does that mean? What's a common term for a lot of liabilities? What'd you say? In debt, exactly. You don't want a company with a lot of debt, right? That means that there's things that they don't own that they owe money on that they have to pay back eventually. And when a company owes a lot of money, there's no owner's equity. Owner's equity could be a negative number, right? Which means that the business is not profitable. They don't have as many assets as debt, which is a huge issue. And so if a company has less assets than debt, their owner's equity is going to be low. The owner's equity, again, is how much of the business the owners own. Now, in a sole proprietorship, that's Michael Delgado, the one owner. When we talk about a corporation, though, owner's equity theoretically is split between all of the shareholders of the company. So if you, an investor, want to invest in a company, you want to make sure that they have a positive owner's equity, right? Because that is pretty much, if the company were to liquidate, your share would be divided up amongst all the shareholders. So that's really what we look for in this stuff. And if you had $10,000 to invest in a company, those would be the things that you would want to look for, right? Amongst other things. Now, what Weston said was correct. You want to make sure net income is positive. But why haven't we talked about profit yet? That's a term that you guys probably know pretty well, I would imagine. You want a profitable business. Profit is kind of the same as net income, all right? It kind of is. For our purposes, because we don't have a lot of other information, that's probably true, all right? Revenue minus your expenses would really kind of be the profit. Now, there's a difference, though, when you get to a more specific definition between accounting profit and economic profit. On the slides, I have this link. You guys can click on it and kind of see the difference. But essentially, the difference is there are other things that businesses have to pay for: interest expense, taxes, cost of goods sold, which is something that we talk about in accounting too when you're accounting for a corporation and stuff. So there's more to it. So a business might have a net income that's positive, but after you factor in taxes, interest expense, all this other stuff, all right, and interest expenses, again, is like fees that they have to pay for loans, they might very well have a negative profit, even though their net income is positive. Okay, so there's more to it than that. We haven't dug into it too much. That's why we have to use that term net income and not profit, because it's not a full definition. Okay. So let's jump into lesson 7.1, which is preparing an income statement. This should be fairly easy for you. Just a quick, I've mentioned this a couple of times, but there are two general areas of accounting. There's financial accounting and managerial accounting. Financial accounting is what we're going to kind of do right now a little bit. We're going to prepare financial statements for users outside of the business to look at. And so if you're a corporation, you have to post financial statements for that business. You have to be able to make them public if it's a publicly traded company like Apple, Nike, whatever, Walmart, all that stuff. They have to have financial documents that are available for you to look at. And you can go on and Google them right now and you could find them. All right. They're a heck of a lot bigger than the ones that we're going to prepare, and they're more confusing and have a lot more terms on it. But the basis of it is the same. Or you have managerial accounting. That's going to be information that are going to be used by managers and other people who are running the business to help make business decisions. So generally, though, you're going to prepare an income statement from the worksheet that you looked at before, and we need to remember what accounts go on the income statement and what accounts go on the balance sheet. The income statement's made up of two things: sales/revenue and expenses, and that's pretty much it. If sales are bigger than expenses, we're going to have net income. If expenses are bigger than sales, we would have a net loss. So we would go through and we're going to prepare kind of a worksheet. And I think at this point, I'll switch over real quick and we'll just work through 7.1 end of lesson review together. And then I'm going to talk about the financial ratios afterwards. So let's kind of go through and do work together. Again, kind of like before, I like to have the slides available just to kind of help go through the stuff. So if you guys want to follow along. I'm gonna make these. All right, so business title at the top, we're using Hair Care Salon. We are preparing the income statement. And our date here is May 31st. So for month ended May 31st. May 31 of 20 dash dash. Because we don't have like a specific year, it's just a general year. And that would be the first part right there. I'll try to make this a little bigger. So hair care salon income statement. You guys just stop me if you have any questions at all. Great, and move on to the next step. This one just asks you to classify all the different accounts. Are they income statements? Are they revenue, expenses, or neither? Cash, that's an asset. Petty cash, asset. So they're neither because they don't belong on the income statement. So we're sorting out what accounts need to go in. So prepaid insurance, these are all my assets. Well, accounts payable is a liability. Capital and drawing owner's equity. Income summary. So we have sales is revenue. Expenses would be the rest. So it should be pretty straightforward, you guys. We have worked plenty with this stuff. Here's about what happened in income summary. Oh, income summary is neither. I missed that one. But that's okay. All right, now for income statement amounts, we're going to look up here and you can see that at the top here, we have our worksheet. This is the same worksheet that we had done before. I'm going to make this bigger because I don't think I really need the slides anymore. You can see this. So we have this worksheet. We have our preliminary income statement and balance sheet. We have those adjusting entries we did. This is all the stuff from before. And all we're doing is we're finalizing this into a final income statement that we would then use if you were working at this business. The business owner would look at it, and that would be the summary. The business owner, unless they're also the accountant, doesn't necessarily need all these details. They're going to look at the bottom line numbers, and if necessary, they can go back in. All right. So what were the sales? We got that from the income statement. Sales here, $5,800. So we'll type in 5,800 right there. And then we're going to go through and fill out all of these expenses. Advertising expense was $750. Cash short and over, that was $3. That was an expense because we made a mistake and didn't account for $3, so we had to replenish that. Insurance expense, 610. Miscellaneous expense, 167. Supplies expense, 540. And the last one, utilities expense, was 300. I have answers just because it's easier. Spend less time. If we add up all of our expenses, we should get to 2,370. 2,370. And that's it. So again, we have columns here to denote individual expenses and then totals here. Sales total is over here. And that is all we need to do for this one. All good. Moving on. You guys in the back, please. Now we just need to calculate whether there was a net income or a net loss. Sales is bigger than total expenses, so we have net income. And all you would do is subtract expenses from sales. And if you do that, 3,430 is the difference of net income. Remember, expenses could very well be bigger than sales. It might also be, remember that there are more than one sales account too. Remember when we talked about our example of like a gym, how many different types of revenue they might have? They might have had like subscription services. They might have had one-time drop-in fee revenue. They might have had, other stuff that they do for like contracting to a gym. So they might have 3 sources of revenue. You would list each and every source of revenue individually, and then you would add them up in here. So individual lists would be in this column, totals for the right column. All right, and now we're at this last one. So we're going to do this together, and then I'll kind of explain what it is. What we're going to do is we're going to use financial ratios, 2 of them pretty much, but the big one is return on sales. That's a big one down here, but we're going to calculate these totals, total sales, total expenses, and net income as a percent of sales, okay? So anytime you do something as a percent of something, you're going to take this number divided by sales, all right? So that divided by that would give you the percent, and you would have to multiply by 100. So if we do 5,800, because we got to do the first one, divided by 5,800 times 100, you're going to get 100%. Because remember, that's kind of turning it into a percentage. So that would just be 100. You don't have to put the percent sign in there, that's fine. If we now do total expenses, 2,370 divided by 5,800 times 100, we get, was it 40, and round it to the nearest 0.1, so it would be 40.9, because it's like 40.86 whatever, right? So 40.9, and that would be it, 40.9. Then the last one, we would go 3,430 divided by 5,800. Times that gives us 59.1%. And that is all for this.